Hi there, I'm Irk, and this is my channel, Get Irked. In this episode, uranium. Will this radioactive heavy metal transform your portfolio into the Incredible Hulk? Before we get started, if you could, please hit the like button and subscribe. It really helps me out. Thank you so much. In this episode of Speculating In, we're going to look at the commodity uranium, which is used in the process of making nuclear energy. Nuclear energy has really been unpopular for the last 20 to 30 years after incidents like Chernobyl in 1986 and Fukushima in 2011. However, with countries across the globe looking at green renewable energy as the future of mankind, we need a bridge energy to get us there. And none of these countries want to rely on fossil fuels, coal, or any of our traditional energy generation sources. Unfortunately, renewable energy isn't nearly where it needs to be right now in order to be able to generate enough power for the grid that we're looking at for the future. Political leaders like Joe Biden and experts in the field like Elon Musk all believe that the only way we're going to be able to bridge the gap between fossil fuels and the future of green renewable energy is through the use of nuclear power. To give you an idea of what it looks like for us to be able to bridge the gap from fossil fuels into nuclear energy, we're going to look at a few different countries. Currently, China gets about 2% of its electricity from nuclear energy, and they want to increase that to 8 to 10% by 2030. That is a substantial increase and will require the mining of more uranium so that they can power the nuclear facilities in order to do this. In India, they currently generate about 3% of their electricity from nuclear power, but they're wanting to increase that to 25% by 2050. The Biden administration also wants to build new nuclear power plants in the United States so that we can generate enough electricity for the power grid that we're planning. With all of the auto manufacturers and many of the states wanting to convert completely to electric vehicles or EVs, that means we need to have a significant power grid in order to be able to charge all these vehicles that aren't currently connected to our existing power grid. Not to mention, investment in our existing power grid has been woefully lacking, as you've probably noticed in news stories like the Texas winter storm that happened last year that nearly knocked out the entire state for weeks. So while the future of nuclear energy seems to be bright, uranium really took off this summer, and you might be wondering what exactly happened. Why did it wait until then to take off? A company named Sprott, which is based out of Canada, is a commodity investment company, and it has usually invested in commodities like gold, silver, and oil. But in August, they created the Sprott Physical Uranium Trust, which goes out on the market and buys physical uranium, also known as yellowcake. Up until now, the electrical companies throughout the world that needed yellowcake in order to be able to power the nuclear reactors were only buying it when they needed it. Unlike other commodities, whether you're talking about lumber, gold, silver, or oil, there was no spot market in uranium. In other words, people didn't know what the market price of uranium was at the time, and it was selling at significantly less than the value of the uranium itself. Once Sprott launched their trust, it created a market that didn't previously exist, and suddenly people realized the actual value of yellowcake uranium, and the price really took off. So now you're probably asking yourself, okay, am I too late to invest in uranium? And if I'm not, how do I even go about doing it? When it comes to sectors like uranium, where I'm not familiar with the sector, I prefer to invest in exchange-traded funds or ETFs rather than looking at the best-in-breed companies. While Cameco Corporation, ticker symbol CCJ, is the leader in the space when it comes to uranium mining, I prefer to invest in the space in the uranium ETF by GlobalX, the URA. The nice thing about using ETFs to invest in sectors that I'm not familiar with is that I don't have to worry about company-specific risk. Granted, if a company in the ETF does go bankrupt, the ETF will decrease in value. It will never go zero unless the entire sector goes bankrupt, which is incredibly unlikely. Additionally, if a company really takes off, it will lift the entire ETF, so you don't have to worry about being invested in the company that didn't take off and missing all those gains. Of course, being invested in an ETF instead of the individual company means that you won't have the same exposure to the upside, but your downside risk is limited so much that it makes it a much more tempting option for me than investing in individual companies. In addition to being considered the leader in the space, one of the other reasons I like the GlobalX Uranium ETF is that its share price is relatively low. You've probably heard me talk about the importance of looking at an investment in terms of its percentage and not its share price, but in this particular case, I can use option strategies to be able to generate more income. And in order to be able to do this, I need to be able to have 100 share lots, and it's a lot easier to achieve multiple 100 share lots if you have a lower per share price. However, I won't get too far into option strategies strategies in this video. It might be something that I cover in a future video. Now let's look at the fundamentals of the uranium ETF, where it's come from, where it's going. I'll present a buying plan to you, and I'll also show you where my own positions stand in URA. The GlobalX Uranium ETF currently generates a dividend yield of 0.6%, which isn't bad considering a lot of specialty ETFs don't have a dividend at all. Currently, the ETF also has an expense ratio of 0.69%. The expense ratio is what the firm charges in order to be able to manage the ETF over the year, which means every year you're paying 0.69% to the firm. However, given that if you wanted to create the same kind of exposure, you'd have to manage all the individual positions that the ETF holds yourself, which would take up a lot of time and perhaps not fit with whatever your portfolio size is. So in circumstances where I'm looking at a very specialty ETF, I don't mind paying a slightly higher expense ratio. For me, I'm paying them to do exactly what I'm hoping they'll do, be experts in the field and know what I don't know and manage it for me. Next, let's look at the GlobalX Uranium ETF on a chart and figure out a buying plan. Let's start by looking at the uranium ETF back at its bottom during the pandemic, which was down here at $6.95 a share. From that point, uranium has really rocketed to a high here back in October at $29.77 a share. However, if you look at the monthly chart, you can see that its all-time high was way back in 2011 at $134.52. This is one of those investments that bring to mind an adage that I like. The best time to invest was 8 years ago. The second best time to invest is today. So even though the uranium ETF has made quite a rise off of its lows, you can see that there's still a lot of potential growth in the future as a long-term investment. I know I referred to this video as the speculating in episode, but I also hold a position in the ETF in my ETF accounts. I don't currently cover my ETFs in the same way that I cover my individual stocks, but if this is something that would be interesting to you, please leave your comments below. So next up, let's use Fibonacci retracement to develop a buying plan that includes levels of where we'll be able to build a position over time. So as always, if you're in TradingView, you create a Fibonacci retracement by hitting Alt F and drawing from the bottom of a move to the top of a move, which creates calculated levels developed by Fibonacci method. Fibonacci being a mathematician who saw patterns that occurred in nature, which oddly enough also occur in the stock market. So you can see that in the different areas of Fibonacci retracement, there's price action that occurs around them. For example, this 23.6% retracement at $24.38 has a lot of price action historically. Then further down at the 38.2% retracement here at $21.05, you can see there's a lot of price historically here, as well as the 50% retracement at $18.36, you can see there's a lot of support back in the past as well. Given how fast the uranium ETF has really taken off, I do believe that we might see a bit of a pullback, but I could also understand if you're a little bit anxious and want to start your position early. So a good starting place might be this low right here around $27.60. From there, I'd probably let the ETF retrace a bit more than just the 23.6% mark. As you can see, it often shoots through it. So right here at $23.50 might be a good second buy target. After that, I'd probably go a little bit lower than the $21.05 mark here at $20.79. However, given that we've had a lot of support back here, rather than going below the 50% retracement, I'd probably shoot for above it, and I like this mark here at $18.60. For my final buy, and I really wouldn't anticipate it getting this low, I'd probably go down here at the 64% retracement down at $15.68. Why don't I think we'll see uranium sell off in the same way? We've shifted a corner now. Unless there's a very serious nuclear event in the future, I don't think we'll see uranium as hated as it has been. In fact, I don't think we'll see it sell off that much at all anymore. With traditional energy sources like coal and oil losing their appeal, I think uranium is the only bridge fuel that will get us into a renewable future. However, those renewables are a long way off. There's still a significant amount of development that needs to take place with renewable energies to ensure that we both have enough energy to be able to operate in the present time, but also to be able to operate when the wind isn't blowing or the sun isn't shining. And out of all the energy alternatives that we really have right now, uranium really seems to be it. Nuclear power really seems to be the bridge fuel that will get us into the future. Now let's take a look at the position that I cover in my speculation and play portfolio. I was obviously a little bit later getting to the party with my first buy on February 23rd, 2021 at $17.97 a share. Since uranium really hadn't started taking off until August of this year, on June 1st of 2021, I made my first sell at $22.71, which lowered my per share cost to $13.23. When the ETF pulled back in July, I made my second buy, replacing some of the shares I had sold higher at $19, which gave me a new per share cost of $16.11, with my third buy taking place on August 16, 2021 at $18.48, which gave me my current per share cost of $16.90. As you can see, after my third buy on August 16th, things really started to take off for the ETF and the entire sector. So from here, I'm not going to take any additional profits at this time. I'm going to let it ride and see where the sector goes into the future. However, I am targeting $24.09 to add more to the position should we see it pull back to that level as we have seen in the past. As I said earlier, because this commodity has suddenly become really popular, it's hard to determine whether or not we're going to ever see it really pull back again, since everybody really wants in. Any dip will be bought in this particular sector, and I think the uranium ETF will demonstrate this over time. For me, the uranium sector is definitely a long-term portfolio position, and although the one I covered directly is in my speculation in play portfolio, I do have a very significant position in an additional ETF portfolio that isn't covered. If you're interested in having me cover ETFs in the future, please leave your comments below letting me know, because right now it seems like people are more interested in individual stocks than they are in exchange-traded funds. Thank you for watching. Please hit like and subscribe, and I'll see you in the next video.